All right, have y'all ever felt like Wall Street's living in like two different worlds? So, on one side, AI companies are spending like there's no tomorrow. And then on the other side, the Federal Reserve is quietly firing over a third of its regulators like it's this cost cutting measure, and somehow everybody thinks everything's fine. So, let's break down what's really going on because this week, everybody, the economy flashed a warning light, and I'm sure a lot of people might have missed it. So to really set the mood today, we had earnings. And Meta stock just had its biggest drop in over 3 years, being down 11%. And the reason why it's not necessarily earnings, but it's something that they decided to drop on money wise. So they decided to drop a bag on artificial intelligence, spending another $25 billion on AI. Apparently, the metaverse wasn't expensive enough. Investors really loved the dream that they're selling, the innovation talk, until they realized AI doesn't mean free. It costs money, and it costs a lot of money. And once you realize it's kind of like lighting money on fire right now until they really figure it out, it's even worse. And even Microsoft, which completely crushed earnings, dropped 3% after saying it's also ramping up their AI spending. As one analyst put it, none of these companies can keep up with this AI burn rate forever. And that's right. And this is the first time we're beginning to see Wall Street question whether or not AI growth can actually pay for itself sustainably and forever. And like I said, that set the mood for today. That was the narrative that stocks moved on. So what we've seen is a lot of realization almost. The Nasdaq fell 1.6%, the S&P fell 1%. And meanwhile, the Dow, which doesn't necessarily care about AI, they're just like over there in the corner, like kind of hanging out, basically saying, hey, you tech bros over there, keep that over there. Y'all figure that out. We're cool over here, because the Dow only slipped 0.2%, so barely down on the day. But while everybody was busy watching these charts go red, the Federal Reserve just made this massive internal move that I think it's going over a lot of people's heads, and especially as they're debating about the health of the labor market. And then they come out and do this. So what they did is, according to a leaked memo, the Fed is cutting 30% of its banking supervision division. That's 150 regulators gone. Poof, right out of thin air. Fed Chair Jerome Powell and Vice Chair Michelle Bowman called it streamlining. And when we translate that over, pretty much what this means is that there are now fewer people watching banks that make risky loans. Because sure, what could go wrong when we cut the amount of people meant to stop financial crises from occurring? And this move comes right after months and months of political pressure. Treasury Secretary Scott Bessent literally accused the Fed of mission creep, basically saying the Fed's gotten way too powerful. And Jerome Powell, he's pretty much saying now, like, all right, fine, you wanted less Fed? Here's your less Fed, everybody. So that's not just bureaucratic news, it's a signal. Less oversight means easier lending, and maybe even looser credit conditions heading into 2026. Now, onto the world stage, and this one is huge. So you might have seen my video earlier. The US and China just hit pause on the economic Cold War that they've been in and made this truce. So after their first face-to-face in 6 years, the US agreed to cut tariffs by 10% on China, bringing the average rate down from this 57% to 47%. That's their average rate. And in return, Beijing promised to really crack down on fentanyl precursor exports, ease rare earth restrictions, and buy 25 million tons of U.S. soybeans every year for at least the next 3 years. And Trump called the meeting a 12 out of 10, but realistically it's more like a 7. But it's still a huge win for global markets. Rare earth powers everything from iPhones, submarines, so a year export relief gives US manufacturers some breathing room and some time to really figure things out between both of the countries. And those soybean orders, That's real cash flow for farmers finally after this drought of money that they've been getting from China for quite a while. But let's be clear, this is more so a ceasefire, not necessarily a peace treaty. AI chips, semiconductors, and tech security, all that decoupling stays in place. So like I said, this year extension pretty much just gives them time to figure things out. And meanwhile, the Senate just voted 51-47 to end Trump's Liberation Day tariffs on Brazil, Canada, and China. It's mostly symbolic. The House won't pass it, but it shows growing pushback against the trade war strategy. Even some Republicans are starting to say, hey, maybe 47% tariffs are a lot. But here's where it really gets fascinating. Markets loved it. They completely loved it. The Dow, the S&P, the Nasdaq, they all rose on the trade news before tech sold off again, because investors they crave for clarity even when the headlines are chaotic, because once you're able to have clarity, you could see a mile rather than like 50 feet in front of you. It's a little bit easier to like drive on the road. That's a good analogy. Now, remember Powell's comments this week that we've gotten. A December rate cut, it's not foregone. We're not completely dead set on this cut that everybody's hoping for come in December. We're far from it is pretty much what he said. And that one sentence, it moved trillions in bets. And before he spoke, markets saw, say, this 90% chance of a cut in December, that December 10th meeting. And now we pull up the CME Fed Watch tool. Where we're sitting at is roughly 74%. So we're down. We're sharply down from where we were. In English, basically Powell said, we're not sure if we're cutting just yet, but we probably are. He just kind of like, hey, we're not sure we're cutting, y'all. And investors hear that and think, so you're saying there's a chance, and we like a chance. We like cuts. We like any possibilities of a cut right now. But it highlights how sensitive this market truly is. AI spending, tariff tweaks, Fed cuts, Senate votes. It all ties back to one single thing, and that one thing is liquidity. And liquidity moves markets. Money flows and drives these markets. And this week, the Fed, the tech giants, the White House, they've all sent mixed signals about how much liquidity we'll actually have next quarter. So what does all of this mean? It means we're entering this reality phase of the post-AI rally. Big tech is learning that AI is in a business model. It's pretty expensive, actually. The Fed is realizing that politics can reshape its power faster than inflation can. And global leaders are realizing that tariffs are fun until they start breaking things that you actually need. This is the market that's trying to grow while everyone's pulling it in different directions. So if the AI is the new gold rush, this week reminded us somebody still has to pay for the shovels. I'll be back tomorrow, everybody.